You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the deep dive. And wow, if you're looking for a week just absolutely loaded with high impact catalysts for global markets, you've definitely picked the right time to tune in. We're talking about some really pivotal economic decisions coming up. These aren't just, abstract headlines. They send real tangible ripples across the financial world, things that can directly influence, stuff you interact with every single day. So our mission today is to take a good look at this upcoming market and news briefing. We want to pull out the most important insights on, foreign exchange, commodities, and the big macro drivers shaping everything. Think of it like your shortcut to being really well informed this week. So, okay, let's unpack this because it's not just any week. It feels like one with the potential to really shift some narratives.
Absolutely. And the core of our deep dive today, really, it's going to center on that interplay between G7 central bank policies and, of course, some absolutely critical economic data points coming out. These data points are going to either sort of solidify or maybe dramatically challenge what the market's currently expecting.
Right. And when you talk central banks, there's always one that seems to, grab most of the spotlight. Let's kick things off with the Federal Reserve. Their policy decision is this Wednesday. What's the main expectation? What's the market thinking heading into this?
Well, the market is pricing it. It's an overwhelming expectation for a 25 basis point rate cut. That would bring the Fed funds rate down into that 4.00, 4.25% range. And this anticipation is largely anchored by the recent softening we've seen in the U.S. labor data, specifically, 2-week payrolls prints back to back, plus some downward revisions to older reports. So for this meeting, that rate cut itself, it's almost seen as a done deal. It's already kind of baked into expectations for maybe more easing later this year.
Okay, so the cut itself is largely expected, but what makes this particular Fed meeting so critical then? Because it feels like there's more to it than just that single number, right?
You've hit the nail on the head there. The actual rate decision, it's important, but it's almost secondary this time. It's secondary to the information that's going to be in the new Summary of Economic Projections, the SA, and particularly what we call the dot plot. That's where each Fed official anonymously puts down their own forecast for where interest rates are headed. And depending on what that dot plot shows, we could see, two very different market reactions.
Okay, two different paths. What are they?
So on one hand, you could get what the market sees as a hawkish outcome. That would happen if the Fed's dot plot doesn't really move far enough towards what the market is already pricing in for future cuts, say in 2025 and 2026. If the Fed signals they're less aggressive about cutting than the market thinks, that could cause a repricing, maybe lift bond yields, and importantly, support the U.S. dollar.
Because investors would expect fewer cuts down the line.
Exactly. But conversely, if the Fed signals a deeper, maybe more extended easing cycle for 2025 and 2026, what we'd call a more dovish tilt, that would likely put some significant downward pressure on the greenback. The nuances in these projections, they're just absolutely critical. And for you listening, these signals from the Fed, they directly impact the value of your currency. That influences everything from, say, the cost of imported goods could make your groceries more expensive to how much that overseas trip might cost you. It really does ripple through the whole economy.
Yeah, that makes sense. And that idea of policy divergence among the G7 central banks, our sources really highlight that for this week. It's clear they aren't all moving together. So while the Fed's in the spotlight, what's happening elsewhere? Let's maybe turn to the Bank of Japan. What's the story there?
The BOJ.
Yeah,
they're on a completely different track. There's a really strong market consensus there. Pretty much all economists and market pricing too, they assign like a greater than 95% chance of no change to their current policy. So the expectation is they hold rates steady at 0.50%.
Okay, so holding steady.
Which means the USD-JPY currency pair, its direction is going to be driven mostly by the U.S. side of things this week. So if the Fed signals fewer cuts than priced in, that hawkish surprise we mentioned, you could see a dollar squeeze pushing the dollar up against the yen. But, flip that around, a clearly dovish message from the Fed, that would invite yen strength pretty quickly as that interest rate difference narrows.
Understood. Okay, let's hop across the border then to Canada. Sources mention crucial CPI inflation data on Tuesday, right before the Bank of Canada decision on Wednesday. What are we looking at there?
Yeah, Canada's interesting. The market is already pricing in about a 90% chance of a rate cut from the Bank of Canada.
Oh, that high. Why?
Well, it's largely down to continued weakness in their economic indicators, specifically rising unemployment. It's hit 7.1% now, and a recent contraction in their GDP. So, like the Fed, a cut is very much anticipated. But the Canadian dollar's near-term direction, again, it's going to hinge a lot on the nuance in the statement that comes with the decision.
The forward guidance again.
Exactly. If there's a hawkish surprise, maybe a more cautious tone than expected about future cuts that could actually spark what's called a short covering rally, that's where traders who bet against the Canadian dollar, the bears, have to suddenly buy it back to close their positions. That can amplify any price rise. And it's particularly relevant because we are seeing quite significant bearish positioning in the Canadian dollar right now. So markets could get caught out if the BOC deviates even slightly.
Right, a classic positioning squeeze potential. Okay, moving across the Atlantic now to the UK, the Bank of England also has a busy lead-in to its meeting on Thursday. We've got jobs and inflation data first. What's the consensus for the BOE itself?
For the BOE, the wide expectation is they'll hold the bank rate steady at 4%, probably via something like a 7-2 vote on the committee, so most voting to hold. But what's really fascinating there, and maybe a bit overlooked sometimes, is that market attention isn't just on the interest rate. It's actually intensely focused on their guidance about quantitative tightening, or QT.
Shrinking the balance sheet.
Precisely. The baseline expectation is for a cut in the pace of QT, maybe down to 75 billion per year. However, if they announced a bigger reduction, say towards 50 billions annually, that could actually provide significant support for sterling, for the pound. It works through what's called the fiscal risk channel. Basically, a bigger QT cut means the central bank is selling fewer government bonds back to the market, which eases pressure on government borrowing costs and, makes UK assets look a bit more attractive.
It's subtle, but potentially powerful.
Exactly. It's a quieter lever they can pull.
Wow. Okay. That is a lot of central bank action, all kind of converging in 1 week. It really underscores how interconnected everything is. Let's shift gears slightly now to commodities, specifically gold. It's shown some, remarkable resilience lately, hasn't it, despite everything?
It really has. Gold continues to trade surprisingly resiliently, especially when you consider the headwinds, like a fairly strong dollar recently and firm bond yields. It's holding just below a key resistance level, around 3,660. And its path this week looks highly sensitive to that Fed message. It's really positioned as a key indicator for market sentiment.
How so? What are the scenarios?
Well, if we get that hawkish Fed message, fewer cuts signaled than expected, we could see gold pull back, maybe retrace towards its early September highs, or perhaps even test the 3,500 area.
Yeah.
That would signal the market is maybe losing a bit of faith in those broader easing narratives that have supported gold.
Okay. And the dovish side?
Conversely, a clearly dovish outcome from the Fed. That could be the catalyst to finally break that 3,660 resistance. That could open the path towards 3,700, maybe 3,750, even potentially 3,800. And what's also interesting is that current market positioning and looking at option skews, it suggests that if a breakout happens, confirmed by those policy signals, it could accelerate quite quickly. You might see a scramble as people adjust.
So how should we think about gold in this environment then? What's the takeaway for someone trying to understand its role right now?
I think the key insight here is that gold, maybe beyond just its traditional safe haven appeal, is acting almost like a pure market barometer for how policy is being translated. Its reaction to the Fed's signals will be a very clear, almost immediate read on how the market is really interpreting those nuances and that forward guidance. Plus, its technical levels are pretty well defined right now, which gives clear trading reference points. So yeah, it's a crucial asset to watch for broader clues about sentiment and risk appetite. It's like a thermometer for monetary policy right now.
It's living thermometer. I like that. Okay, beyond the central banks, there's another critical piece of U.S. economic data you mentioned earlier, Thursday's jobless claims. This feels like a really big piece of the puzzle for understanding the Fed's thinking, right?
Oh, absolutely. Thursday's U.S. jobless claims number is, well, it's a crucial confirmation point for that whole labor softening narrative we talked about. That narrative is one of the main reasons the Fed is expected to cut rates in the first place. Last week's number, that spike that pushed claims out of that long-held 200,000, 250,000 range, that was the first really significant break we've seen in years. it hinted at a potential turning point in the jobs market.
So everyone's watching this next print very closely.
Extremely closely. If we get a second elevated reading this week, that would definitely reinforce those recession concerns, cement the dovish Fed expectations, and likely weigh further on the dollar. But if we see a sharp reversal lower, if claims drop back down significantly, and if that's paired with a less dovish message from the FOMC, you could actually see the greenback strengthen as those immediate labor market worries ease off a bit.
Okay. We also have U.S. retail sales and industrial production later in the week, but it sounds like they're probably secondary unless they're way off expectations.
That's generally the thinking, yes. Unless those numbers deliver a really sharp surprise, the main focus is almost certainly going to stay on the central banks and that evolving labor market picture. And if we try to tie all these threads together now, looking at the bigger macro picture, that policy divergence theme, it really remains the key driver for FX markets right now. You've got the G7 central banks, and they're clearly at very different stages in their easing cycles or potential easing cycles. So it's the interaction between the Fed's chosen path, the Bank of Japan's ongoing patience, the pace of the Bank of Canada's easing, and how the Bank of England carefully recalibrates its QT. That whole mix is really going to determine cross-asset positioning and near-term currency direction.
It's a complex dance, isn't it?
It really is. What an intense week ahead. So just to recap quickly, the FOMC decision, and especially that dot plot trajectory, they sit right at the heart of everything, but they're surrounded by these other critical data points: U.S. labor conditions, Canadian inflation, U.K. services prices, all feeding into that bigger story. It's certainly a lot to keep track of, but that's why we do these deep dives, right?
Indeed. I think traders, investors, anyone watching the markets should stay laser focused on how these G7 central banks frame that forward path for rates, because that forward guidance, really more than anything else this week, is what's going to set the tone. For currencies, yes, but also for broader cross-market risk sentiment in the days and probably weeks ahead. It's all about reading between the lines.
Well, thank you for joining us on this deep dive into what promises to be a fascinating week for the financial landscape. Our goal, as always, is to give you a clear, comprehensive understanding, hopefully empowering you with the knowledge to navigate these complex markets. And, considering all these different policy paths we've just discussed, these diverging strategies from the major central banks, it does raise an interesting question for you to think about. How might these differences, some banks easing, some holding firm, maybe some tightening later, how might that reshape the whole competitive landscape for international trade, for capital flows, for investment over the next few months, maybe even the next year? Something to ponder. Keep an eye on these developments, and we really encourage you to continue your own deep dive into the global economy. We'll be back next time with more insights.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.